All right. Hello. Today I'm Andrew Walker, host of Yet Another Value Blog. Today I'm happy to have on one of my favorite authors, Byrne Hobart. I say have on. This is just the test kit. Byrne Hobart from the Diff. We're thinking about doing a monthly Fintwit book club. We read on Byrne's suggestion More Than a Numbers Game. We'll include a link in the show notes. But Byrne, I'll talk it over to you. You chose More Than Numbers Game, so why don't you quickly? I love having the hard copy. Why don't you quickly say why you chose it, your thoughts on the books and everything?
Yeah. So I basically part of the reason I read this book was that I was reading, I think I was reading Super Money, and it mentioned. So that book was written in the early 70s and was it's by the same guy who wrote The Money Game. It's a really fun book. Among other things, really early interview with Warren Buffett, and it talks about how investors vary in how sophisticated they are. And one of the things it says is some investors are so anxious to do the work and do the research and know their companies that they don't just read the annual report. They literally go to the SEC and read this weird thing called a 10K, and it has the stuff you won't find in the annual report. That was interesting. And the other thing it said was something to the effect of some investors don't even wait for the annual earnings number. They literally look for the quarterly numbers instead. And to me, this is, like saying some investors calculate what they think the stock is worth before buying it, or like some investors use limit orders. Like this is like really, really obvious stuff. And so, but then, if you go back far enough, if you're reading 19th century trading anecdotes, it's totally reasonable to think, okay, these people did not really know what earnings were. Like, did they know what depreciation was? Maybe, maybe not. And I realized like we've made a lot of progress in accounting, and even though there's probably more progress to be made, like we are in a much better situation than we were in the distant past. We're in a much better situation than we were when I first started looking at financial statements in the early 2000s. And I wanted to know where that had come from, how it had happened, and also I also had this general sense that a lot of accounting judgments seem superficially wrong until you try to come up with a better alternative. And then you decide that, okay, this is maybe not great. Like maybe we could have done it another way, but this is actually a pretty good idea. And so that's stuff like, I don't know, hold so I think like the first accounting change that I remember reading about was the end of goodwill amortization. And that there was a Buffett letter when I first started reading Buffett letters that talked about this change, and Buffett thought it made sense, and that if you were to acquire all of Coca-Cola, it wouldn't make sense to depreciate the Coke brand down to zero. But it also struck me that this stuff is kind of arbitrary. Like the financial statements, the cash flows are not changed, but the numbers that you as an investor see do change. And then, and you and I talked about this a little bit over email just before the show, that sometimes the numbers investors see, even if those numbers don't really correspond to cash flows, those affect their decisions. They affect how they value the company. That affects how the competitors of that company behave. And so good accounting is actually very, very socially useful because it's not just a scorecard for any one firm. And you can take the libertarian view, which I think is fine. If you run your own business, do your accounting however you want. And if you happen to run out of money and you didn't realize that that was going to happen, that's your loss. And maybe you learn why some accounting principles are generally accepted and some aren't. But if you run a public company, I think there is some obligation that if people are going to look at your financial statements and respond to them, it's very important to society that these financial statements accurately reflect reality. And so this book is just the story of how people made that happen.
I'm just going to yes and a few things there, but first I'm going to divulge. Sometimes I'll get emails from listeners. They'll be like, "Hey, I love the podcast, but when you talk, I need to listen on 1x speed, and when your guests talk, I speed up to 1.5 speed." And I think you and I might be the first example of two people who are so passionate and fast spoken. People might need to turn this down to 0.75 times speed if they're going to do it. But to
That's the
yes and
goal.
everything you said, I really liked everything you said there. I love the point you said where people used to go and he'd be like, these crazy people will go and read the 10K instead of just the annual report. And it reminds me of like in the 30s before Ben Graham came around, like everybody was just buying stocks kind of like crazy. And then Ben Graham said, let's calculate the asset value. And like today, if you were like, I'm buying this stock at 8 times price earnings, I will always say, unless you've got more insight behind that, you're probably going to get your face ripped off. But let's go with the last thing you talked about. I love that point because the anecdote, I think my favorite anecdote in the whole book is It's towards the end. WorldCom is capitalizing their line expenses. In this book, it should be noted, is released in 2008, and I want to ask you questions about that later. But WorldCom's capitalizing their line expenses, and because of that, they look much more profitable than AT&T, their competitor. I believe the book says AT&T looks like a lazy dinosaur or something. And AT&T, who is expensing their line expenses, and if you capitalize something, basically divide by 10, 20, whatever, you're going to report much higher margin than someone who's expensing. AT&T looks staid, and they fire 20,000 people, and they buy a ton of cable companies for over $100 billion and almost destroy AT&T. And I had just never heard of a company almost getting destroyed by a competitor's fraud before. So I thought it was so interesting there. Everything you said, where I know I call management teams all the time. I'm like, hey, your margins are 5%, your competitors' margins are 8%. Why the discrepancy? You need to get up there. You're lazy. You need to fire people. And it kind of really drove home, hey, fraudulent accounting statements, yes, it can mess up with the company, but it can really mess with other companies, competitors, everything. It has real impact. So I'll pause there. Anything you want to say on that?
Yeah, I think that's true. Like there is this weird dynamic where so I recently read this anecdote that about the story of the Mechanical Turk, not the Amazon project, but the thing it's named
Yep.
after, where it was like this fake chess playing robot. There was really just a guy under the robot moving the chess pieces. But apparently there was a British inventor, Edmund Cartwright, who saw the Mechanical Turk and he fell for it. But he thought to himself, if it's possible to build a machine that is sophisticated enough to play chess, and surely you should be able to build a machine that can weave. And so he built an actual power loom, an early prototype of a power loom. So sometimes the fraud does force people to step up their game. They're like, how can we possibly beat these people? We have to work much harder. They do work much harder. And it turns out that the fraudiness was very slight. And I think that is also something just worth noting on a lot of accounting frauds. Like there are a handful of frauds where it's just the plan from the beginning is we're going to lie about our numbers and rip people off. But the way a lot of them happen is that just this one time, just this quarter, we are going to front load just this one transaction and we'll hit our numbers. And, we know we're capable of hitting our numbers. So it's not really a big deal. And in fact, some of the '90s accounting frauds they did start with hiding profits, and Enron did some of this too because their trading desk was just so wildly profitable that one they wanted the cookie jar so they could offset future write-offs, but two they just really didn't like the optics of California is in the dark because the power
Because
companies are
we're
going
milking them
bankrupt,
for all
right?
their worth. Absolutely. Yep.
Yeah, yeah. So, but yeah, I think generally it is corrosive to have different yardsticks that look like the same yardstick from the outside, but that actually are measuring different things. And because like I think that is part of the purpose of accounting, and the book talks about this, is that you want to be able to compare different companies, and you don't just want the CEO of the New York Central saying we're the best railroad, look at our dividend, and the head of the Penn Central, like the head of the Penn Central saying the same thing. Like you actually want to have some kind of way to quantify who owns what return are they getting, and what is driving that return. So I think it does come from a really good place, but then accounting is this attempt to take a really messy world of abstractions and then turn it into something concrete and rules driven, where you want a situation where if you had two accountants prepare the same firm's financial statements, they would have exactly the same number. And I don't know if anyone has ever tried that, but I assume that there's like a very small
It,
limit of like company size after which that you basically never get the same number from two different people.
it's funny because one of the through lines throughout the book is Arthur Anderson is mentioned 5 times, or it's mentioned tons of times, but 5 times they say Arthur Anderson was the place the most where they wanted every accountant to give the exact same number, like no discretion. Everyone plays and follows by the exact same rules. And when you said that, like, I think that might have been in the '90s the place that was most likely where everyone would get you to the same rules. And part of that, and there was obviously 100 other stuff, but it clearly seems like that desire and that culture is ultimately one of the many things that led to their demise. I'd put it at, like, if there were 100 issues, I'd say it's probably number 6 on the list or something.
Yeah, I think what happens is I think any good accountant would say that accounting approximates economic reality. It does not perfectly correspond to economic reality. So there will always be a gap. And if they say that, then part of their discretion is potentially giving the company more credit than the strict application of the rules would do. And some of it is saying, look, guys, like it is very obvious that if you own just enough of this special purpose entity to not consolidate it on your balance sheet. And then you're doing business with that same entity, and its collateral for the derivative it writes to you is a derivative on your own stock that you're also explicitly designing so you don't have to report that. Like they you'd have to look at that and say this vehicle has no purpose other than moving risk off the balance sheet, but the risk is still there. But if you are sufficiently rules driven and it complies with every single one of the rules, and Enron has hired really good accountants of its own who know exactly what the limits of those rules are, then maybe you are stuck saying that just per our ethics statement, we absolutely must approve this particular instance of lying to your shareholders.
When you say that, it's like they hire a really good accountant who know how to take the rules to the exact limits. Like if they had come along 20 years later, they probably would have been so rich, like trading crypto or prop trading, like very specific. I think about something. Will the U.S. government market shut down on Polymarket? When they reached the deal, I think it dropped towards no for a second, and then enterprising traders read the fine print and said, "Oh my gosh, like the U.S. government will technically default for an hour. This is a yes." Like Enron's accountants would have been so perfect at that. It's like, no, in one life it's fraud, in the next life they would have been great prop traders.
Yeah, although I think that you can almost view prop trading as like the pro-social application of the same skill that allows you to commit accounting fraud. Because if you like some prop trading is you find an interesting pattern and you find the most cost-effective way to exploit it. And sometimes it is like you reason really carefully about how this asset you're trading is structured or how you yourself could structure this trade. And you find the one detail that other people are not thinking about. Like the one thing where, hey, if you don't pay attention to the correlation between these two assets, then a derivative that touches both of them is worth X. And if you do pay attention to that correlation, or you pay attention to how that correlation would change in different scenarios, then the value of the derivative is something totally different. So they are sort of doing this distributed bug bounty program where if someone has put together an asset that just doesn't make very much financial sense and is inevitably going to blow up, the prop traders are the ones putting some of the downward pressure on that asset's price, and they do keep things in a slightly better equilibrium. So in that adversarial scenario, that skill set is actually really valuable and does make the market more efficient and does keep people from making dumb mistakes. But in a scenario where you're cooperative, then it's tricky. And actually, the book talks a little bit about this question of who's going to pay for the accountants, who's going to pay for the audit, and
Yep.
how that question has evolved. And there are just no good answers.
It,
There, like if investors pay for the audit, you either have one audit per investor, and then you have a ton of duplicated work, or you have one investor pays for the audit, and then everyone uses the audit. In which case, the biggest investor is basically paying a tax to keep the rest of the market
rewrite. Yep.
informed. And so maybe the least bad option is you have the company pay for the audit, and you make sure that, and over time, investors have just learned that there are auditing firms that are a really good signal. There are auditing firms that are kind of a neutral signal. There are auditing firms where you actually want to have an alert, like you want to scrape or like you want to subscribe to the RSS feed of new S1s and have an alert that triggers every time a particular auditor is involved in a company that's going public, and then you immediately add it to one of those watch lists that displays the borrow cost right there. You
Uh,
know what's going to happen. Yeah.
I'm laughing because if the top investor pays for the audit, I'm laughing. You could have a scenario where Byrne owns 100,000 shares, I own 100,001 shares, and then I'm like, I sell down to 99, that you sell down to 98,000, just
Right.
like because we're trying to pass that bill back and forth. I like also your audit costing, right? One of the through themes of this book, and one I really wanted to talk to you about is how cyclical finance can be, right? An audit cost. Hey, who should pay? The investor or the company? Obviously, the company pays. There can be mismanagement. How much? This book was released in early 2008. How much does that remind you of the ratings agencies issues that would spring up like literally as this book is getting published, where people were debating, oh, isn't it kind of strange that the companies pay rating agencies for their ratings and then like investors, especially credit funds, rely on it? And so we can talk about that. Or I was just struck by there are 1,000 other examples of, hey, in the 20s, people are relying on dividend payments to estimate earnings. That sounds a lot like yield codes in the 2010s to me. Hey,
Mhm.
in the 70s, one of my favorite is in the 70s, banks come to the accounting boards like, hey, if we've got a loan that's had credit issues, but we can modify it so we still expect full repayment, can we not take a write off because it would destroy our capital base? Like it had so many rhymes to the held to maturity things that destroy Silicon Valley Bank, or even kind of some of the mark to market issues in the 2000 crisis, 2008 crisis, wherever you want to go. So I wanted to ask you, like, what did you think about those through lines and that cyclicality? And I'll have a counter example to that to follow up on.
Yeah, and I think another thing that is it wasn't structured this way, but economically was equivalent to this was that if you think about sell side investor compensation before the 2003 settlement,
Yep.
in effect, the companies were paying for coverage because the sell side researchers get bonuses based on the underwriting that their bank does, and that underwriting is partly a function of did they put a buy rating on a company that issues lots of stock and lots of convertibles. And so, in effect, like if you look at just the flow of funds, the flow of incentives, it is pretty economically equivalent to companies pay for coverage and they pay for good coverage. And that didn't work, but what it did mean was that there was a lot of coverage and it was pretty widely available. And now we have this situation where it's much harder for firms to engineer things so they get really good coverage to the extent that they can. They're actually paying in kind by doing management meetings at conferences hosted by the banks that whose analysts they get along with, and it's just really easy to get along with someone who thinks you're a swell CEO whose stock is tragically undervalued. It's just great to have something like that in common with someone. Um, so now, but what we really have is a system where the institutions are paying for the research, and it turns out that they're perfectly happy to pay for research, most of which is the research they're paying for that is distributed internally. So there's still a lot of really great equity research out there, but it's not very far out there. It gets forwarded to half a dozen people within one firm. They make the trade. That's how the research is monetized. So in some ways, when you have a setup for paying for information and the information can be widely available, if you align incentives really well, such that that information, so such that there's a really strong incentive for that information to be accurate, you're also creating an incentive for that information to not be widely distributed. And I think in the case of the firms just paying their auditor for to audit it to have some stamp of approval, um, part of what that does is it means that the auditors know that their value to every other company is contingent on their willingness to say no to whatever client is closest to the line. And it seems like the structure of the industry, it doesn't really support that there would be multiple firms where you can actually stack rank their reputation. It's just really hard to be the second most reputable of the big firms. It's a lot more feasible for there to be this cluster of big companies where it just means you've got approval from a big company, and then smaller companies where it means some combination, like smaller auditors, where it means some combination of one, yeah, you just can't afford to pay EY that much money right now. It would not be a good use of shareholder funds. But two, maybe you can't afford to have someone from EY looking at your books and asking themselves whether or not it'd be good for their firm's franchise if your firm got a clean opinion.
Did you see Super Micro? I think you wrote it up, so I think you
Yeah.
did. You see Super Micro? That one of the most fascinating things. So for those who weren't following, Super Micro was a growth darling. I think I calculated it. It was like the Russell was up 10% last year, and 1.5% of it I think was Super Micro. So like from January to March, Super Micro stock 5x's or something, and then it graduates from the Russell 2000 to the S&P 500. Russell 2000 kicks it out, and then Super Micro has all these accounting issues, like tons of accounting issues, insider trading. There's a short report, all this sort of, sorry, not insider trading, some allegations of self dealing. There's a short report, all this sort of stuff. And the stock gets dropped 80%. So it's funny because I have been wondering if it had been in the Russell 2000 for the entire year, I think it would have dragged Russell 2000's returns like from 10% last year to 7.5, but neither here nor there. The interesting thing for the discussion you just had was uh, Supermicro's accountant resigns in kind of like fiery accountant fashion, right? It's one of those things where if you
Mhm.
read it and didn't know anything about accounting, you'd be like, that's normal. But if you read it and you had read like 100 audits,
Right.
everything, you'd be like,
This
oh
was the
my
one where they're
God.
like, we think you can rely on paragraphs 1 through 7 and also paragraph 9 and paragraphs 15 through 20 or something. Like when they were just saying point by point, like this is the part you should not trust.
Yes, yes.
That's pretty bad.
And the interesting thing about that was A, because it was a fiery letter and the stock was going crazy. But the other, like, that was a big four firm that resigned. And this is a Supermicro is still a 50 billion EV company, but a big four EV firm resigned with the company on fire and with that dramatic letter. Like, who can step in? Because if you're the firm that steps in, then is it because you think you'll take like more risk around the edges than that other firm, or are you flat out saying the other firm was wrong? Are you creating a reputation as like kind of a monetizable place? Like, hey, pay us a little extra and we'll let you like skirt around the edges, because that might be a disaster for the rest of your business. And the solution probably was obvious in hindsight, but it was like if there's a big four and then there's a middle 10, like one of the lower rung middle 10, I think took it. But I just thought that was a crazy example of everything you're saying. I'll kind of toss it over to you.
Yeah. I think in a situation like that, if there are that many outstanding accounting questions, I think the thing to do to make the business a viable large cap again is you actually just basically say you're hiring the new auditor to confirm that everything the previous auditor said was right. And you do a massive restatement and you pay that new auditor a lot of money because you are going to drop them for a big four as soon as you have a chance to do so. But I think if both sides understand that, and if that Big Ten company, like for the duration of that client relationship, they at least get to say in their presentations to other clients that we do audit one member of the S&P 500, and we're hoping to expand that franchise. And you hope you don't get too many follow-up questions. But I think yeah, it is really tough to get out of accounting messes, and I think a lot of them do start out with just honest mistakes. And
Yeah.
and part of when the book is describing just what companies did even internally, and I guess that is another point to bring up about the book, is that it's part of what makes modern accounting so annoyingly complicated is that it's actually two schools of thought that got merged into one. And one school of thought was, I am a London-based investor, and because I like growth and I like excitement, I am lending money to the hot tech stocks of the day, which are American railroads.
Railroads.
And because I don't want to be sailing across the ocean every so often, I need accurate financial statements. I need to know what my money is getting. But since I'm a bond investor, what I care about is, I put $1 million into this company. Do I have $1 million worth of assets? And I know that as long as that's true, my investment is pretty secure. And yes, there will be cash flows, but I don't have access to the upside of those cash flows. I just get whatever, I just get the money that I am contractually guaranteed to get. So they cared about that. And then the other piece was just controlling costs and understanding product mix from the perspective usually of a manufacturer, where you are General Motors, you make a bunch of different kinds of cars, they all use different components, and you just want to understand, should this assembly line stop making this model and make the next model or not? And what is the payoff if I make it out of this material versus that material, et cetera? And those are just really different questions. Like one of them is actually looking at a stock of just, a set list of assets, and then one of them is looking at a flow and looking at the interrelations between those flows. But you do need to answer both, because the stock is the accumulation of flows over time, especially if the company is not paying out all of its earnings as a dividend. So they kind of had to merge those two schools of thought, but it's just two different groups that are thinking very differently. And one group is thinking about maximizing profit and upside. One of them is thinking about controlling downside and having some liquidatable collateral that backs some loans. But to have if you produce a series of balance sheets, you have to link them with P&L and with cash flow statements. So you kind of have to do both. But if they start with different assumptions and different goals, then it's tricky to tie them together. But that is to say that, like, when you look through this history, there are just a lot of cases where people had to make judgment calls. They had to think about those judgment calls. One of the pieces I really liked in this was the anecdote about when the U.S. government was giving companies a tax credit for capital investment. There were actually really good arguments for the two different accounting treatments. One of which is, okay, you bought $1 million machine, you get a $60,000 tax credit. Therefore, you actually spent $940,000 on this machine. So depreciate it as if that's what you'd paid. And then the other school of thought was, no, you got a $60,000 check in response to something you did for your business. So that's revenue. And you can kind of see it both ways, but it was also true that I think that one of the reasons that accountants do tend to just choose the more cautious of the two equally defensible viewpoints is that you never want to give someone an incentive to do something more aggressive than they really want to. Or you never want to give them financial statements that reward just maximum risk taking, even, and reward it similarly to just the outcomes of more prudent decisions.
I think that goes through nicely to my next question, which was my overall takeaway from the book. I think maybe as like somebody who really practices it, but throughout the book, almost every chapter, you will have an example of companies, investors screaming at their accountants, "Hey, you can't do this!" Like debt that used to be off balance sheet. You'll have an example of an accounting regulation that would require them to bring it on, and they'll be like, "You can't do this. Our investors will go crazy," or expectancy stop comp, all these examples. And for every example, except for one, the one is maybe EPS shares in the 90s is the one example. But for every example, but one, companies like, "You're going to destroy the capital markets, you'll destroy us." And then he kind of dryly follows it up with, Capital markets doesn't care. There have been studies, capital
Right.
markets are off balance sheet, on balance sheet, expense, capitalized. Like capital markets get there, and maybe one company can like fool the market, but on the whole, it doesn't really change. I was really impressed by that, and I thought about that. I want to ask you about that, and then I want to ask you again. The book stopped in 2008, so I do wonder. Well, let me ask you about that, and then I'll follow up with the present day.
Yeah, yeah. So I think, part of that is actually to the credit of these companies, where they are arguing with their accountants. They are saying this change is going to destroy us. And for that not to happen, it has to be the case that they were actually behaving pretty economically rationally. Like they
Great point.
were, because
Yeah.
if they were gaming it, then absolutely it would destroy them. And like this comes
Enron,
up
right?
with
Like, yeah.
stock-based comp. Yeah. Like with stock-based comp, there was this funny tweet a couple weeks ago from someone saying like, sophisticated investors don't debate this. And I couldn't tell which side it was taking. I couldn't tell if it was taking the side of just ignore stock-based comp entirely or of just treat stock-based comp as if it were a cash expense and pretend that the company is continuously doing secondary issuances to pay employees' salaries if they're paying those salaries in stock, because those are economically equivalent. Um, and it is the case that there are some companies where just, the price makes a lot more sense if you pretend that stock-based compensation isn't real. But then you look at the long-term chart for those companies and you're like, well, if I had bought this because the valuation made sense because I ignored stock-based comp, I would not be in a happy place right now. Like Snap. Snap has been very generous with its shares, and the shares have not really appreciated over time. But um,
The
yeah,
other thing
they.
is you talk to these companies because it's generally tech companies that you're talking about
Mhm.
this, right? And you talk to Snap or Twitter was very much in this place as well. It's like, look, man, we're competing against Facebook and Google. Like you are the average engineer versus the super above average engineer or the above average. Like there's a huge difference. We compete with them. And it's like, what do you want us to do? I mean, I've literally had them ask me, it's like, what do you want us to do? Yeah, we're spending 8% of sales on stock. Our stock goes down all the time, so it's not like it ever comes out. And if we don't do that, then we're never going to hire an engineer again. And they're kind of like damned if you do, damned if you don't. And I guess the correct answer might be short them, long the Mag 7, and go sit on a beach.
Yeah, I
But
mean, I think that is often the answer. Is like if because someone like Meta or Zoom, like both of them have moved much more towards it's cash. Like we're doing cash comp, and we're not. It's just there's too much confusion about our economics, and also we can afford it because we have cash flow. Um, so yeah, if you're competing against a company like you have an engineer, you really want to hire them. You have to pay 800K to beat the Meta offer, and Meta can do 800K in cash or stock, and you can only do 800K in stock. Well, um, to the extent that that works, it has to be the case that either you like someone has to be misvaluing the stock, and if it is like employees are going to overvalue the stock, they're going to assume that it always goes up, then maybe that is actually economically rational. But it should still be something where if it's economically rational to spend money this way, you should be willing to disclose it. And I just like my thought experiment is always that if you imagine a company that just switches from half cash, half stock based compensation for its employees to all cash compensation, and we're going to issue enough stock to pay all that cash, that has no change in the economic value of the company, other than one, if employees are more incentivized by the stock, and two, if the underwriting fees are higher than whatever the administrative cost of just giving employees stock options is. So if there's any change in how you value a company, if they say that they're doing that, then something is wrong with your accounting.
well,
And I think,
that
yeah,
the answer might be, hey, do you like accounting or do you like making money? That's how it feels. The answer is sometimes.
I mean, I've never heard someone say that during a bear market.
That's a great point. I think that discussion of stock comp, which we could have had in the 90s. I mean, there's a big section about the 90s stock comp. We could have had post dot com crash, or we could have it today, which I think speaks to how cyclical these things could be. Let me fast forward that today, because one of the debates I have a lot with my companies, with other investors, is I'll just give a specific example. There is one company in industry that recently they switched their financing from a way that would finance their inventory off balance sheet to on balance sheet. So it brought on a decent bit of debt. This is a pretty asset inventory heavy. It brought on a decent bit of debt, and most of the other companies in their industry have that sitting off balance sheet. There's no funny business here, just like the terms and everything. That's how they works. And I know a lot of investors, partially myself included, were like, dude, this is bad for this company. Like, how are they ever going to get out of this doom loop? They screen with more debt. Disaster for quants, disaster for screening. In a world of passive, how is this good? And the company's like, hey, we can save 50 basis points a year on hundreds of millions of dollars. Like, that's pretty meaningful. So economically it's better for them. But I guess my question to you, and I will admit, I kind of lean towards the economics, just to tell, maybe I'm biasing the witness. I kind of lean towards the economics, but I can see in a world where today it's all quants and all index are the most, do you think that the screaming that for 100 years companies put up, you destroy our optics, you destroy our company, do you think that's more meaningful today than it was throughout this book's life cycle?
I don't actually think so. I think a lot of those quant strategies, like yes, it is true that if you change something about your economics such that you do actually produce more free cash flow, but also it looks like you have more leverage, but you actually had that leverage all along. That yeah, there will be some systematic strategies that are selling, but those strategies, they're, long 600 stocks, short 800 stocks or something. So it's incremental. It does add up because there are a lot of them, and a lot of them are using very similar signals for the good reason that those signals do tend to work. But one thing the company is doing is it's actually engineering this turnover in its shareholder base, where proportionately more of its investors are going to be people who care about cash flow and economics, and fewer of its investors are going to be the quants and indexers.
But
And
are those people
yeah.
people with a higher cost of capital, right? Like a person, let's say I run a 10 stock fund and all of it is like deeply researched. My cost of capital is going to be much higher than the quant strategy that's long 500, short 500, and just like kind of playing the statistics. Isn't that right? Just because I need some return on my time, isn't my cost of capital higher than that?
That's actually a tricky question because I think the quants would think about capital a little differently from the way discretionary investors do. And typically, I think at least my perspective starting as a discretionary investor was that the default portfolio is 100% net long, 100% gross long, and then anything you do beyond that is something extra you do. So like I mentally benchmark everything to, am I doing more or less more, now that I've gotten more quantitative, I think about, am I trying to have more volatility than the S&P 500 or less, and what's my beta versus the S&P, and what's the incremental contribution of this position to my overall volatility and structure. But so if you're running one of those quant strategies where you are massively diversified, you're using lots of different signals, you have a position in basically everything liquid, and because of that, because of all that diversification, you can lever up. You wouldn't want to think of the cost of capital in terms of what is the prime broker charging them for the incremental capital. You do sort of want to think of the cost of capital in terms of, if they take on this much more risk, then how much more equity do they need? Like how much collateral do they need to send over to their prime broker? And I think that in that case, your cost of capital difference is probably not that high. And also, like the cost of equity capital is sort of what is the return that you're missing out on if you don't do this. And that is something that the quants can probably calculate a lot more accurately than discretionary investors can. But it's also something where the quant number is probably going to be higher, and it should reasonably be higher. Like they should target a higher return because they have more historical data and have a better sense of what is the actual return on the equity slice of what you're doing from this particular set of strategies. So yeah, I also think that if you're thinking about the cost of capital for individual discretionary investors, or for discretionary investors generally, you also do want to think about just the return on time function is a little bit tricky because one, you do get some level of upside from researching one company and understanding more about its overall industry. And like I'm actually looking at a company where the part of the thesis is, hey, they got kicked out of an index, so that's bad, for their stock price temporarily. And the other is that the core business is one of those nice, fairly high margin industrial companies, but they decided to become a big conglomerate, so they bought a distributor, and so the distributor added a huge chunk of revenue, a tiny amount of profit, and now if you screen them, the industry classification is still machinery, but they suddenly look like a kind of average margin machinery company, but it's actually or it's not machinery, it's like industrial stuff. They're just a
Well,
smallish manufacturer.
you have what's the Leonardo DiCaprio line from Django Unchained? Like you had
Oh
my
yeah.
attention, but now I'm gonna be hitting you up for that company
Okay,
after
yeah,
this.
no, it's like
But
it's an interesting one where it's basically like part of what I think is like if a rogue asteroid destroyed the distribution company, I think the stock would probably go up over the next year relative to counterfactually, because suddenly they'd look like a high margin, like a more interesting company. But so that's a
isn't that
case
proving my
where they
point though?
don't.
Because I was asking like about companies that
Yeah.
screen poorly, and you're saying, hey, this is a company that did a weird deal. Now they screen as something that they're not in this case, and if you just hide that off, the market's inefficient enough to go up. Isn't that proving my point on, hey, these companies, my inventory debt example, like if they just
Mhm.
took it off balance sheet, economically be a poor choice, but their stock might go up because they screen better. Aren't you kind of like
So yeah,
giving me?
I'm coming to that in the short term, but I think the thing that offsets that is private equity, where they do care about cash flow. They fixate on cash flow. They're very good at modeling balance sheets and P&L and cash flow statement, and they are very good, at least when they control the company, at making the choice that does improve cash flow, even if it makes the accounting numbers look bad. And like pretty much every S1 I look at for a PE owned company, it's reporting a GAAP loss and has been persistently reporting GAAP losses. And when you read the letter from the chairman and read their description of the business, they're clearly describing an actual good, viable business that's generating cash flow and that is accruing value over time.
I
So I think they're fine with it, and they it's a large asset class. So
I agree
I
with
think
you.
they eventually take
And
things out.
in the infinity, that is the fix, right? But I do think in the short to medium term, because the company you described, if private equity bought it today, they would have no problem with the margins. The company I described, they'd keep it the exact same way. But in the short to medium term, like when you're looking for alpha or undervalued stocks, I do think it's interesting because look, private equity can't buy every company. And I know, like I have a lot of friends in private equity, they don't go hostile on companies, right? They need like they need the royal carpet rolled out, like, hey, we would like you to buy us. So you could have a company that's trading inefficiently. In my hypothesis, you could have them trading inefficiently for 3, 5 years until really an activist comes in and either forces them to sell or makes it so uncomfortable for the board that they sell. So
Mhm.
agreed, in the long term, like private equity will do it, and there are all sorts of other reasons why levers will get pulled for it to be efficient. But I do think it's still an interesting question in the short to medium term about it.
I do. I think, like, I guess the nice thing about some level of diversification is that if you have a diversified set of long-term bets, it's always somebody's short-term, right? So there's always some case where it's actually working out pretty nicely. And yeah, I think it's just I think it is very hard not to make money. Like if your analysis is correct and you understand why someone is selling a particular kind of company and you understand why that's the wrong decision. It's very hard at scale to actually lose money taking the other side of that transaction. In fact, like going back to the prop trader thing, that is sometimes that's what they're looking for is who is trading this with an other than economic motivation and how can we step in and exploit that? Like my favorite example of that is looking at the Sharpe ratios of buy and hold strategies for corporate credit by credit rating, where the highest Sharpe thing to do is buy the highest rated junk bonds, and the lowest Sharpe thing to do, the very lowest Sharpe thing to do is buy just like triple C rated things that are just about to default. That's for lottery ticket reasons. But the other low Sharpe thing is buying triple B rated bonds because everyone who has an investment grade mandate knows that that's where all the action in their universe is. And then companies know that if they optimize for exactly that credit rating, they will be investment grade and be as levered as they can be while being investment grade. And there's just infinite appetite for that particular kind of paper. So if you have and I presume that the reason this gap doesn't close is that it would be hard to actually get cheap enough funding to lever up this portfolio. But if you could do a massively levered portfolio of long double B, short triple B, I think you get an interesting return profile, and you do periodically have upgrades that immediately push something into the overbought rather than oversold category, and you monetize that by selling.
I suspect you'd also have sizing problems where like the size of the triple B universe is probably 1/10 of the size of the size of the double B is probably 1/10 the
Yeah.
size of the triple B. So it's like, cool, you want to do this trade and you're quickly running into liquidity, sizing, all this sort of stuff. It is interesting you mentioned because they mentioned Milken a few times in this book, and they had an anecdote that I had never understood before. Like they mentioned Milken, obviously fascinating guy, fascinating example. I didn't realize this is their suggestion, but I believe they suggest, hey, a lot of Milken's success, and this is true for a lot of people who are successful. A lot of Milken's success come from a few tailwinds, and they specifically point to some tailwinds in the tax code. I believe in 81 they allow something to be deductible that hadn't been deductible before, or no, it was accelerated depreciation, and they point to a few other examples that like really right when he's getting big, really like set the tailwinds on fire for his thing. And I just never heard of those specific tailwinds. So I was very interested in that, and that relates to the high yield example you lay out.
Yeah. Milken, he did actually have some pretty good timing. Like if you
Oh,
get
yeah.
into fixed income when rates are high and there's a recession, and then the economy grows and rates go down, then that's pretty good. And yeah, there were some other. So I reread Predator's Ball a couple of weeks back, or a couple of months back at this point, and it was really fun. And one of the things it did point out was that his brother was actually really good with taxes, and that at the time that Milken was active and earning a lot of money, there was this provision in the tax code where if you bought a treasury bond, you could allocate and then you sold different pieces of it, like you sold the principal or you sold the interest rate component. You could actually allocate your cost of capital as you wished between those. So buy treasury, sell a zero coupon bond, and you've immediately taken a capital loss. And treasuries are yielding 15%. It's a pretty substantial capital loss. And so he was compounding money pretty fast in gross terms, and then in after tax terms was probably compounding about as fast at that
You
point.
could, I mean, that's so crazy because you could do that. That's basically an infinite money machine. Like you could be reporting negative short term. Nothing's tax advice. We should have hit 1,000
Right.
disclaimers, but uh,
I mean,
look,
like looking at the historical tax code stuff, like there is a lot of stuff where it was just like infinite money machine, and either people didn't know about it or they actually felt like there was just not a large enough population of really rich people who were actually willing to exploit it that way. But stuff like oil depreciation allowances, where you could basically write off some of the revenue from oil as the cost of the oil not being in the ground, and there was no symmetry where if you drill for oil and discover oil, you have to realize a massive capital gain on all the oil in the ground. No, you just depreciate that capital that you got for free, sort of.
do you think the reason that these existed in the 70s, 60s, whatever, and I don't, to my knowledge, I mean, maybe there's the secret rich cabal that knows a lot of them, and there are like good tax loopholes and stuff, but the reason they were seen more prevalent then, do you think it's because hindsight bias? Like we hear of the five people who made $1 billion doing these, and we don't hear of the thousand. And I want to ask hindsight bias, or do you think it's because, hey, there was no internet, capital was a lot slower back then. So if you were really like up and coming, you could really study these and take advantage. But today, if that happened, there would be a Reddit board saying, "Hey, look at this
Right.
famous money hack," and either the government would shut it down because so many people would do it, or that's probably what would happen. But do you think it was,
Yeah.
I guess, lack of information, or do you think just it's hindsight bias that did that?
So I think those both matter a lot. Like Control F is just a wonderful technology. If I could bring one, if I wanted to maximize my net worth, and I could bring one computer tool back in time to 1955, Control F, and then just having a digital version of the tax code, then yeah, pretty much infinite money. Um, I'd probably end up in prison somehow. But yeah, in the meantime, lots of fun. But I think the other one is that there is this co-evolution between what the tax code tells you to do and what you end up doing. And my favorite example of this is Ronald Reagan destroyed the Midtown dining scene because he changed the tax deductibility of dining and entertainment from 100% deductible to 50%. And if you think of 100% deductible entertainment, top marginal tax rate in the late 50s of 92%. That means that if you take someone out for drinks as business, it's a 92% off happy hour versus just going out and having fun on your own. So that's where the three martini lunch came from, is that these were really, really affordable martinis in after tax terms. It was a massive tax arb. And I think there had to be some point at which people just didn't do that, and then some point at which they realized that this is like the only, like, you should not really be, except for special occasions, you should not be going out to eat without some business purpose in mind because it is so much more affordable. And then suddenly a lot of business culture revolves around this, and you start to realize like the tax code is actually this massive cirrhosis subsidy and is causing a lot of people to be pretty dysfunctional starting at 1 p.m. and also isn't, it's not collecting that much revenue. And so we can reallocate some of society's resources away from midtown dining establishments and towards other socially useful things if we say, okay, we're going to cut the top marginal rate, but also all of these games you're playing, you've got to stop playing these games. And also, like, corporate perks used to be a lot better at that time because those were also fully deductible. And I think some of that was just the IRS not asking some questions it should ask, like, what is the business purpose of this apartment, of this car, of all this corporate travel? Like, I'm sure they could have had some awkward conversations had they chosen to, but yeah, in an information scarce environment where you're one of the overworked, beleaguered IRS people, and you get this massive document from General Electric. Are you actually going to go through every line item and figure out if everything's a legitimate expense or not? Probably not. You're probably going to look at the line that says real estate and not, the list of every apartment that GE rents for executives and try to figure out which of those are actual, things for someone who's temporarily in the city and needs a corporate apartment to stay in versus someone who is just getting their housing paid for with pre-tax rather than after-tax dollars.
I think it was you who said, "Hey, like the three drink policy, it basically formed the plot for Mad Men, right? Without that
Yeah.
IRS code, we wouldn't have had Mad Men, the TV show." I want to ask two more things. So one of the things as I'm reading this book, you see, and I think it's with the benefit of hindsight, but you see so many crashes coming, right? And one example is, hey, in the 70s, they go for the loan things I talked about earlier, where hey, if we've got a loan that had even credit trouble, if we dismiss interest payments for 1 year and push it out by 2 years, as long as we'll get paid par, we can keep it marked at par. And obviously that's a disaster. And they argue that sets up the savings and loans crisis. And there are plenty of others. The other one I use is, hey, how many times do you see somebody saying, hey, this market reminds me a lot of 1929? You'll never hear about any of them except for the one person who calls it right. So I just want to ask, when you read this book and you see all of these parallels to today or things you saw, do you think that's because of perfect hindsight bias, or do you think, like I said, economists call 9 of the last 5 recessions, hindsight bias calls 10 of the last 1 crashes? Do you think that's hindsight bias, or do you think it is possible, like in the moment, to kind of use these historical parallels to actually help you avoid shenanigans?
Yeah, I would say if you're looking for just a carbon copy, you won't find it. Like there's just not going to be another company that starts out owning natural gas pipelines, creates these special purpose entities, has a really profitable trading division, and then loses all of its money on dumb stuff and has a run on the bank. You're not going to find that, but you will find cases where they find a way to follow the letter of the law such that their net income looks good, their cash flows don't seem to correspond to that net income, and they've found some case where they can make their business look better than it really is. But also with a lot of these, it's for me, it was really useful to try to take the other side of these arguments and try to figure out, well, aside from just they want their P&L to look better or they want their earnings to be smoother, like did they have a reasonable justification? And I think specifically the chapter where they talk about inflation, it started making me think about inflation and how you should account for it. Because they give an example of, let's say you buy a truck and it generates some revenue and the cost of trucks is rising really fast such that the economic depreciation is higher. Like the replacement cost of the new truck means that your trucking business is actually a net destroyer of capital. But what I realized was one, insanely hard to actually model all of this stuff. Like you just, you need to have like the more narrow the CPI component is, the more the person you're talking to can say, well, that is weighted to a slightly different kind of truck than the kind that we buy. And so we want to use a different number. So just like infinite debates, unless you just say we're going to use nominal values. But also a lot of companies' obligations are in nominal terms. So they don't borrow in CPI linked bonds. They borrow in bonds whose interest rate bakes in some assumptions about inflation. And when they pay people, like part of the reason that inflation is, a little inflation is something economists like, is that a little bit of inflation means you give everyone a continuous pay cut, and the only people who are maintaining their standard of living are the ones who are getting raises. And that's just a lot easier than having a totally flat price level that doesn't rise over time and having to tell people once a year, hey, we're cutting your salary by 3% because you're just not as good as you thought you were, not as good
Or
as you thought you
because
were.
everything's getting more productive, efficient, and yeah,
Yeah.
on your
So like
truck.
to me,
Go
like on
ahead.
that, like that actually felt like, of all the ways you could do this, just using nominal stuff and not adjusting for inflation is actually the one that just leads to the fewest arguments. And it means that since everyone knows these are nominal numbers, the higher inflation is, the more the equity analysts are thinking about inflation, the more the credit analysts are asking themselves, okay, what is the replacement capex for this, and what does that do to cash flow over time? So you have the analysts asking good questions for how do we actually price this, and then you have accountants asking good questions for what is this, like what does the company actually own, and what is a number that everyone can agree on. And so in some sense, like the economist or the accountant's job is to choose an answer that is like 85% right, but everyone can understand the logic, versus 99% right, and we can spend forever debating the logic.
No, look, I'm completely with you. I like the trucking example, but you know what came to mind when I was reading that if you look at the department stores, and the department stores are probably the number one destroyer of value investors' capital over the past 15 years. There might be another, but it'd be hard, especially famous value investors. You think about Sears, you think about J.C. Penney. But I always look at the department stores, and once a month, I will have a friend email me and be like, hey, Macy's market cap is about $5 billion. And if you look, everyone agrees their real estate is worth between 8 to $14 billion. Like, so you're buying. And my argument is very along the lines of the trucking argument. Like, hey, yes, that's correct. But they're reporting a profit of, if their market cap is 5 billion, they're reporting a profit of 400 million. So it looks very cheap. But what it is you have $10 billion of real estate, which probably would generate $800 million on its own, right? Supporting a negative $400 million enterprise value. So, or supporting a negative 400 million retail business, if you kind of do that
Mhm.
math quickly.
Yeah.
And your issue is until you unlock that real estate, the retail business destroys value. The management team there doesn't appear like they're in a hurry to, because they'll put them out of their job. They're a retail business and they sell the real estate. So that trucking example you have, and I believe they do make this example, it can lead to all sorts of perverse incentives where it seems like the company's doing great when you're reporting nominally in profit, management's getting big bonuses, but actually they're destroying tons of value. And they give a few more simple examples, but that was just one that came to mind on the inflation.
Yeah, I think it's a division of labor thing. Like it is probably the case that you know, 100 shares of Macy's is expensive and 10% of Macy's shares outstanding is cheap because with 10% you get
I
someone on the
like that.
board and you tell them, yeah. So, and I think there are a lot of
There
companies
have
like
been a
that.
few shareholders who have tried to
Yeah,
disastrous results.
yeah, and then you start just thinking, like trying to ask yourself, okay, why does this gap persist? Like, why doesn't has the board never told management, hey, like we are going to give you the world's most generous change in control provision for your severance. We're going to vest 300% of your equity if you please sell the company. Like they could do something like that. They could give the management an incentive to leave. Or if the board is just going to resolutely refuse to stop burning $400 million a year in opportunity cost on the retail business, someone out there is willing to buy it. And maybe the actual conclusion you reach is, Amazon would love to have permission to buy Macy's. They would pay double the current share price just to get the real estate. They would turn it all into either Macy's branded but run by Amazon, or Amazon branded and just, rule Herald Square. But if all the buyers can't actually buy it, and if selling it piecemeal means you worry that you get halfway through selling it before there's another downturn in that kind of commercial real estate, then maybe it's actually pretty fairly priced, and maybe it's fairly priced because that price is the equilibrium between really high number if you look at what the mark to market value of the real estate is, negative number if you mark the actual cash flows of the business to market, and then you average those and you get current market cap.
I also think there is, you had this with US Steel. If US Steel had been named anything else, I think that deal to Nippon would have gone through. And Macy's, not that the Macy's name itself, but it is so high profile. I think if you had Macy's sells to anyone, right? They sell
Yeah,
to a real estate firm who's going to shut down Macy's. They sell to a real estate firm who's wink, wink, not gonna shut down Macy's. They
right.
sell to Amazon. There's going to be so much political pressure. So I think they're almost locked into, everyone knows it's inefficient. Everyone knows the real estate's worth more, but there's just not really a way to extract it.
So you know what? This is why Macy's can't mark up the value of their brand name and have it reflect all the brand equity, because right now that brand name is clearly a liability. Like they
Yep.
would pay billions of dollars not to be Macy's, not to have the star. I found out a while ago that the star was actually a tattoo that the founder, Mr. Macy, had because he was a sailor. Um, yeah, the
That is
Macy's logo is a tattoo.
That's fair. The other thing is the Macy's Thanksgiving Day Parade. I think, if I remember correctly, now it's getting $200 million to be broadcast by NBC Peacock. And you think about that, $200 million for, I think it's 20 years. That's probably worth $2 billion MPV, slightly more, slightly less. Macy's as a whole is worth $4.5 billion right now. So just their parade. Now, I don't know if they're getting it or who owns the parade or something, but it's interesting. Last question I wanted to ask you. If you read this book, there are hot button issues in every decade, right? So 70s, we mentioned inflation, especially around the oil embargo is a big one. 90s to 2000s, Sarbanes-Oxley, the accounting scandals, there's stock comp. But if you read this book, if I said, hey, Byrne, as you and I sit here beginning of 2025, if there was a book in 2035 released, What do you think the hot button issue in accounting that it would point to today would be?
So I think the real answer, it's an answer that doesn't actually qualify for hot button treatment. It's just not something people get agitated about. But I think that more big tech companies in particular should like it is more realistic to understand their business if they capitalize more of their intangibles. It is like every year it gets a little bit harder to look at return on equity numbers, and it gets, the market's price to book value tends to drift up over time. There's that nice chart in the book, which feels very nostalgic
From
because
one
it's
to
like,
six, yeah.
yeah, it used to be 1 to 2, and then there's this weird aberration where it goes 1 to 6, goes to 6 in the 90s, and yeah, we're back. And but I also, investors understand that. I think the other thing, so I wrote this piece a while ago about how capital intensity is a feature of where you are in the cycle and not of the industry. Because if you look at a lot of the great capital light companies, they end up finding that the best way to expand the capital light business is to do some pretty heavy capital expenditures. Like Amazon, there was the debate in the 90s over whether Amazon or eBay was the better ecom business. And for a while, eBay traded at a premium because they were so asset light. Their customers are the ones who are storing all of the stuff, and the customers are handling all the logistics. And then it turned out that because of that, they just could not guarantee the same speed of shipment and the same selection that Amazon could, and that speed of shipment and selection mattered a lot more than capital intensity. So in some ways, it's a self-correcting problem, but it feels like if you could look at the true economic balance sheet of Google, it's more like a 10% return on equity business, and a huge chunk of that equity is the algorithm and the brand name and the internal cohesion of the employees and like the culture, stuff like that. Like that all has value, and they're getting a return on that value, but it's all capital that they had to accumulate. But that's no one is going to be furiously testifying before Congress asking why didn't Apple put why isn't the Apple brand worth $800 billion on the Apple balance sheet, and like why isn't Nvidia capitalizing Jensen's vibe and depreciating that over time as he gets
Yeah.
older or whatever. But I think that's when I analyze companies, that is part of what I'm looking at, is like how how valuable are the intangible assets, and then can they turn $1 of dollars into more than $1 of intangibles? And if they can repeatedly do that, and then they are getting this return on the intangible asset, and that intangible asset raises the return on the tangible asset, then they have a nice formula, and they'll keep growing, and they will out earn their cost of capital. And if they can't, they
I
won't.
hear you, but I think the book coherently argues, and it, like the issue is how do you put that intangible there, right? Because I'll just give you Google. You said I think it's a 10% return on equity business, but like, okay, Google 2 years ago was a 400 billion market cap. Today it's $1 trillion market cap. So are you going to argue they threw on 600 or five, whatever trillion of intangible without investment, right? But just because of the market cap, like it gets really cyclical, and that's why the accountants and if they ever did that, you would absolutely like every time we get a 2022 and every big cap company drops by 30%,
Yeah,
and they're all like that's the issue. So I definitely hear what you're saying, and it's obviously a shortcoming of accounting, but I just feel like it's settled math, right? Like they've had
yeah,
R
I think it
R&D
is,
company,
and
yeah.
I'm exaggerating a bit, but I think one way to do it is just you capitalize more of the R&D and even marketing expenditures, and like that is in effect how people look at a lot of SaaS companies, is they implicitly capitalize the sales cost and just depreciate it over the life of the contract. So in some ways, that does actually line up with how companies make decisions internally and how investors are valuing the outputs of those decisions, and those are your two constituencies. It's what is the company deciding to do? That's like the operations and control legacy, and then it is what is the market deciding to do, and that's the British investor investing in an emerging market like the United States philosophy. Like if they both agree that this is an asset that you capitalize and you depreciate over time, then I think it does make some sense. Like I don't actually think it's worth doing. Just the last time there was even like a moderate tweak to SaaS accounting, it was just a pain for everyone to update all of their models, and everyone is already taking the models and basically trying to have the unit economics machine of what return do they get, how are their cohorts evolving, and how fast can they jam money into the adding new customer logos machine, such that they continue to add customers who have good net dollar retention and will cause revenue to drift upwards. So like, I guess I don't have like I don't think I have a really strong, here's where the accounting is bad
Look,
view. Unfortunately, I wish I did.
I'll
Like
give you.
maybe what SPAC warrants. Okay, they should not actually have to mark them to market. That is just the SEC messing with people. Just they couldn't ban SPAC, so they did the next best thing.
Look, I thought for 15 minutes trying to think of one, and I spent all my time in financial statements, and I couldn't think of one. So I was putting you on this. There's a softball question that was a 101 mile per hour fastball question, but I will give you one other interesting one, and you can comment, you cannot comment. You mentioned the price to book ratio chart, which I really like. And for those who haven't read the book, haven't seen the chart, it's from like 1920 to 1990. The Dow traded for between 1 to 2 times book pretty regularly. And then in the 90s, it trades up to 6 times book. And, that's bubblific, but then it comes back down to 4. And his argument was, hey, it's because we're getting more intangible heavy companies. And now we're probably way past 6 with NVIDIA, Google, all these things in there. But I was thinking about that. And then everybody loves to quote the Buffett indicator, which was market cap to GDP. And for years, it was if you get over 1 to 1 market cap to GDP, you're in a bubble. And now we're way past that. And that's because guess what? A lot of these firms are international. And I was just thinking, like, there's 2 indicators which for 50 years, if you had been using them, you could have kind of like traded around them. What is the
Right.
indicator now? And these are market level, not firm specific, but what is the indicator now? And I was wondering, like, hey, maybe price to earnings, because we're having so many companies, with AI, they're front loading so much of their expenses. Maybe price to earnings is broken these days. I don't know. Like, ultimately, I'm a value investor. I do believe like fundamentals will reflect cash flows in the long term. But what are some rules of thumb that investors have always used that might be breaking? It is an interesting way to think about, because as an investor, if you can find broken rules of thumb, that is where there is a lot of alpha, either on the long side, or for years people said Netflix subscription businesses can't go past $30 billion was the rule of thumb. If you knew Netflix for XYZ reason was going to break that, what is Netflix now?
Right.
800 billion market? I can't remember last time, but you would have made a heck of a lot of money. I'll pause there and let you have last thoughts on that.
Yeah, yeah. So I think you could actually take two related rules of thumb, and say they are both breaking. One is, yeah, the earnings things, where it is just you, especially if you're looking at a high growth company that has recurring revenue. Like basically, the higher the quality of the recurring revenue, the more you can predict next year's revenue based on this year's revenue, the less this year's PE tells you anything. But the other piece of that is that I think like looking at price to sales and growth, and basically assuming companies will grow into a decent high margin business at scale. I think that's also breaking down, because the model for a ton of SaaS companies is we are going to sell something to customers who are growing fast. As they grow, our business with them will grow along with them. That if you are Zoom and you sell to a company that's growing 50% a year, or they're growing their sales team 50% a year, they will need 50% more seats in their Zoom license per year. But that also means that company is not growing into a new margin. Like they're always paying Zoom some proportionate toll of their business. So my line in an older Diff piece was, one company's net dollar retention is another company's lower steady state gross margin. And I think that means that you could have a lot of these companies where, because the software ecosystem has gotten so good, because there are so many things that you would have had to build a bad version of internally, but you can buy a really slick version of externally, that their steady state margins are actually lower. And then with AI, people are very aware of this at this point, that an AI business, it may be a software business, it does not have software margins. Like there is an incremental cost to every user interaction, and it's pretty high. So that also means that you can't just say, well, every software business eventually reaches 90% gross margins and stays there, and then there's eventually cost leverage on the R&D side and cost leverage on the marketing side, and so you eventually expand to some steady state of 20 or 40% EBITDA margins, depending on how much of a superstar business this is. So yeah, both of those go away. And if some software companies end up looking a lot like subscale manufacturers, where they make $1 of revenue, and 20 cents goes to employees and 65 cents goes to suppliers, and there's something left over for shareholders, but it's just not that much, and it's a lot of work, and there's short product cycles and things. A lot of these companies, it ends up looking, from a balance sheet and P&L and cash flow statement perspective, you feel a lot more like you're investing in a steel mill than in Microsoft circa 1994.
It is interesting though, the only thing is like, I just, maybe it's because I've had 20 years of it ingrained in me, but it's like, hey, even if that's the case, isn't there somebody down the line who's going to buy them and be like, oh, we can rip all those costs out? And I guess with steel mills, you kind of had that, but with a software company, just because like you can't rip all the costs out of a plant, but you can fire a lot of people in the software company.
Well, but
Yeah, but
that's
I just think
those are the costs where they do expect to get the leverage, and they still will. But I think a lot of the incremental costs of, you're probably not going to build a better Zoom, and Zoom knows it, and maybe Zoom and Google Meet compete a bit, and Teams is there too. But for a lot of these, like a lot of these companies also recognize that there's someone else, some other big software companies that sells the same feature set, and so what they're always trying to do is get as many integrations as possible. So if you got a Slack bot that pings you 2 minutes before the Zoom meeting and it pulls the relevant files from your Dropbox, and if it sees that you haven't logged in, it detects that you're still at another meeting and automatically sends an email to someone, and that's sent through Superhuman or something. Like if you have all these integrations, then switching providers is just this giant technical lift. And so
oh yeah.
that is again, intangible asset does not show up on the inconvenience of switching off Zoom does not show up as an asset on Zoom's balance sheet, but it is absolutely a source of positive, it's a source of incremental DCF dollars down the line.
The book has he works at IBM with Lotus Notes for a while, and it mentions that as an example of intangibles. And I was laughing because in the 2010s everybody knew Lotus Notes was terrible, but there are still big firms, even I believe to this day, who are still on Lotus Notes despite the fact it's a disaster of a system. Because as you're saying, once you get all those integrations, it's very, very difficult to be like, we've got 100,000 employees, we're all switching to Gmail. It like just
Right.
destroys all of those integrations. Byrne, we are way over an hour. We're going to chat a little bit after this, but this has been great. This was our sample podcast. If you got suggestions, anything for Byrne, we'll see how this goes. But I really had a fun time. So this has been awesome. This was our book club, and hopefully we're doing another one next month.
Yes, indeed. Already.